Ladies and gentlemen, thank you for joining us today and welcome to the second Investing in India program. My name is Prasenjit Chakravarti and I'm a partner in the corporate practice group at Khetan and Company. It is truly my privilege to extend a warm welcome to each of you wherever in the world you are joining us from. We are honored to have such a distinguished audience with us today. In our previous session, we established a strong foundation for understanding India's legal and regulatory framework. We explored the roles of key regulators, essential laws such as Companies Act and Foreign Exchange Management Act, and the distinctions between automatic route and approval route for foreign direct investment into India. This foundation equips us to navigate the complexities of India's investment landscape effectively. Today, we will delve deeper, moving beyond the basics to focus on the critical considerations for investing in India. Our discussion will cover the regulatory landscape, sector specific restrictions, and key investment instruments while addressing practical challenges such as compliance, governance, and risk management in joint ventures. Additionally, we will explore strategic approaches to mitigate risks and leverage opportunities in this dynamic market of India. This session is designed for corporate executives, in-house counsels, investment banks, intermediaries, and advisors, offering practical insights to help you navigate India's evolving investment ecosystem. We encourage your active participation today, and we are confident that today's discussion will provide valuable takeaways to address your concerns and guide your investment strategies effectively. On this slide, you will see the agenda for today's webinar. We encourage you to submit any questions you might have using the Q&A facility in the webinar portal. While we will try our best to address all your questions during this session, but should we be unable to cover any of them, we will respond offline by email. Additionally, please note that a copy of this presentation along with the summary notes and a recording of this webinar will be sent to you later after the session as a standard practice. Now, India as a investment landscape and destination has emerged as a prime destination for foreign investment, backed by its vast consumer base, skilled workforce, and significant improvements in ease of doing business. Key government initiatives, including production linked incentive schemes, tax benefit, state specific incentives, and advancement in infrastructure and digital transformation, have created a very robust investment ecosystem. However, navigating India's regulatory framework, especially in foreign exchange laws, is essential to minimizing risks and maximizing returns. Success in market requires a strategic approach that integrates business goals with compliance requirements, which will set you up very nicely to have a successful investment journey in India. Despite certain challenges, India's regulatory involvement is evolving to become more investor friendly, presenting immense opportunities for those who can adeptly manage its legal complexities. In today's session, we will delve into this critical role of foreign exchange compliance in structuring successful investments. Our goal is to provide you with practical insights to leverage India's dynamic and growing market effectively. Now, let me take a moment to introduce our speaker for today. You should have already received an email with detailed resumes of both our speaker, Mr. Atul Pandey, and myself. So I will keep this brief. Our presenter today, Mr. Atul Pandey, is a seasoned expert with extensive experience in advising foreign clients on a wide array of foreign exchange related matters. With that, I would like to hand over the floor to Atul to begin today's session. Over to you, Atul.
Thank you, Prasanjit. Good afternoon, good evening, and hello, everyone. Uh, so today I will be actually dealing about foreign exchange laws. When actually foreign investor is looking into Indian market, what are the applicable rules and regulations? Which are the regulators to reach out to, and how the regulations play out? So, in relation to foreign investment, the mother legislation for any investment and the key regulation which has been framed is under Foreign Direct Investment Policy and Foreign Exchange Management Act. Foreign direct investment policy is the policy document which broadly overlays what are the policy requirements, what is to be looked into when a foreign investor is actually looking to invest into the Indian market. The foreign direct investment policy document is framed by Department of Industrial Policy and Promotion. We call it as DPIIT. It comes under Ministry of Commerce. Then Foreign Exchange Management Act is the mother legislation, and this act has been framed by Ministry of Finance through central legislation. At the same time, the rules and regulations framed under Foreign Exchange Management Act are framed either by the Reserve Bank of India or by Ministry of Finance. In relation to any foreign investment, the recent rules which had been framed was by Ministry of Finance as foreign exchange management, non-debt instrument rules. And then, of course, foreign investment is also regulated by sector regulators, and these sector regulators come under various ministries which actually regulate these sectors. So that is a broad gamut of applicable laws which a foreign investor has to keep in mind. And in the next slides, actually, I will be dealing more about the regulators. Now, what are the relevant government agencies which are actually regulating foreign investment? Now, as I mentioned, the mother legislation, Foreign Exchange Management Act, has been framed by Ministry of Finance, which comes under Government of India, and the Foreign Direct Investment Policy document, which actually gives the broad overview and the policy regulation with respect to any investment. That is framed by Ministry of Commerce. And Ministry of Commerce has a specific wing to kind of implement and execute foreign investment policy related decisions. And that is basically framed by Department of Promotion for Industry and Internal Trade, DPIIT. Then within Ministry of Finance, there is a department called Department of Economic Affairs, which actually again advises from a policy perspective in relation to foreign investment. And then there are sector ministries. For example, if the investment is coming in pharmaceutical sector, it is Department of Pharma. If investment is coming in defense sector, is Ministry of Defense. If it is coming in telecom sector, then it is Ministry of Telecom, and so on and so forth. Now, in relation to any investigation with respect to foreign exchange laws and its compliances, then the ministries as well as Reserve Bank of India, they can investigate these compliance issues through their investigating arm, which is Enforcement Directorate of India, and they actually look into both compliance and violation of foreign exchange laws as well as any money laundering related elements or violation and contravention. Then, of course, a Reserve Bank of India also has a very important role to play because they also frame rules and regulation as foreign exchange regulator. And the job of Reserve Bank of India is also to ensure compliances, and all the filings and compliances have to be made to Reserve Bank of India through the Foreign Exchange Department and ultimately, through the authorized dealer bank. So that's in a broad nutshell about how the government agencies play out. And in the next slide, I will be basically discussing how the regulatory framework plays out in relation to these sectors, and whether there is any approval required, whether there is any prohibition in relation to these sectors. So in terms of foreign direct investment policy as well as non-debt instrument rule, foreign investor has to keep in mind in which sector they are actually going to make investment, because under Indian foreign direct investment policy, most of the sectors are under the automatic route. Automatic route means that sector where you don't require any approval from any sector regulator or from Reserve Bank of India or from any of the ministries or agencies of Government of India. So most of the sectors, because Indian economy is fully liberalized, so most of the sectors are under the automatic route, and therefore no approval is required. The sectors which typically fall in this category are services, manufacturing, trading, and any kind of ancillary services, information technology, and of course even some of the critical sectors have also been now made under the automatic route. Then the approval route sector are those sectors where approval is required either by the sector regulator or by the Reserve Bank of India, and in that case we have to make an application to obtain approval from the sector regulator or the concerned ministry. Now, in under the foreign direct investment policy, as I mentioned, because most of the sectors are under automatic route, but there are sectors which may be partially under the automatic route and partially under the approval route. So, in case if there is a breach of sector limits with respect to automatic route, then approval will be required from the sector regulator. For example, in pharmaceutical sector, the automatic route limit is up to 74%, which means that foreign investor can invest up to 74% without any approval. But beyond 74%, and to take it up to 100%, because under up to 100% foreign investment is allowed in pharmaceutical sector, so beyond 74% approval will be required from Department of Pharma. Likewise, DPIIT. Then, in addition to that, in 2020, government also introduced, a legislation or kind of a notification which is called as Press Note 3 notification, which actually provides for any investment coming from a country which shares land border with India. In that case, any direct or indirect beneficial ownership, if applicable, then government approval will also be required. One important aspect is if you have already obtained approval under the approval route sector from Government of India, and in the approval letter, if the condition is that so long as there is no change in foreign equity percentage for which approval has been granted, and if you simply want to invest additional amount within that Indian company, then no approval will be required, even though the sector falls under the approval route. But if previous approval has been obtained and the condition is specifically mentioned that no approval required in case if there is no breach in foreign equity percentage, then in that case no approval will be required. And there are certain sectors which are absolutely prohibited. For example, real estate, gambling, tobacco, lottery, transfer of any development rights. So these are some of the sectors where no foreign investment is allowed, which means that these are prohibited sector. And in the next slide, I will be basically discussing about what are the entities which a foreign investor has to consider. So typically for foreign investment, a foreign investor prefers a private limited company, although they can also invest in listed company, because foreign direct investment has been defined as any investment coming in an listed entity or any investment coming in a listed entity in excess of 10%. So that is how foreign direct investment has been defined under the FDI policy, foreign direct investment policy. So private limited entity is the preferred entity option for most of the foreign investors if they are either looking for a strategic or a financial investment. Now, private limited company can be set up in a period of 4 weeks if the sector falls under the automatic route, and in case if a sector falls under the government route, which means that where government approval is required, thereafter only once you have obtained the approval from government, then only you should set up your private limited company, and that can also be done within a period of 4 weeks. And in that case, the sector regulator or the registrar of the companies, at the time of setting up the company, they ask for approval letter from Government of India in case if sector is under the approval route. Then we also have the option of limited liability partnership for a foreign investor. They can enter into partnership. They can set up a limited liability partnership. Under the foreign direct investment policy, it has been provided that if a foreign investor wants to set up a limited liability partnership, then it can be done only in those sectors where 100% foreign direct investment is allowed under the automatic route. which means that those sectors, for example, trading and manufacturing and services, that is where you can set up an LLP. And it also provides for that there should not be any FDI linked performance conditions with respect to that sector. So for setting up an LLP, two things have to be considered. It should be falling under the automatic route where 100% FDI is allowed. And second, there should not be any foreign investment linked performance conditions. Lastly, foreign investor can also do market reiki in case if they do not want to set up a private limited company, or they do not want to set up a limited liability partnership at the very inception, and they just want to understand the market, or if they have to undertake some business activities on behalf of their foreign parent, then the option is also to set up a branch office for carrying on certain business activities on behalf of the foreign parent. Then there is also an option of setting up a license office to kind of understand the market, do licensing or marketing activities. And in case if they have a specific project in hand, then they can also set up a project office. So these are three preferred mode for a foreign investor when they actually look at the Indian market. And in the next slide, actually, I will be talking about Press Note 3, which was issued in 2020. As I mentioned, when you actually look to make investment in India, sector is very important. But in addition to that, you also need to see what are the specific press notes and conditions under FDI policy. And in 2020, government issued Press Note 3 when it clearly provides for that if any investment is coming in a sector, whether the sector is under automatic route or government route. But in case if the beneficial ownership or the investment is directly or indirectly coming from a country which shares land border with India, then in that case, approval would be required. Now, how approval process is managed is basically, again, the application is filed to DPIIT, Department of Internal Trade and Promotion, and then they actually forward the application to the sector regulator. For example, if the investor who is located in a country which shares land border with India wants to invest in pharmaceutical sector, then the application will go to Department of Pharma, or Telecom, then it goes to Department of Telecom, and so on and so forth. Now, all kind of investments under Press Note 3 has been, covered. Uh, what government actually looks into Press Note 3 application is, the background of the investor, the background of their management. There is a security clearance requirement under Press Note 3. So government actually asks the foreign investor to file a security clearance form, and Ministry of Home Affairs actually look into all those details. They do their independent verification, and basis that the approval is being given. And in under Press Note 3, all kind of investments are covered, whether it's a direct investment, indirect investment, whether the investment is in relation to an existing Indian entity where there is a foreign investment, and whether it's a rights issue or whether it's a bonus issue. So all kind of investment activities are covered. And generally the approval timeline also gets impacted depending on the role and the background of the investor. So in the next slide, of course, when we discuss about the timelines, then we will get more in detail in terms of how it plays out. But having said that, in a broad nutshell, what are the key considerations for foreign investor when they are actually investing in India? So one is, of course, the investment instruments. So under the FDI policy or foreign direct investment policy, the instruments could be either in form of equity shares, or it could be equity like instruments. For example, it could be compulsory convertible preference shares, and it could also be compulsory convertible debentures. So these are the permissible instruments through which a foreign investor can make investment in India. Then the second important aspect is structuring the local presence. So in that case, you have to decide whether you want to, as a foreign investor, you want to set up a private limited company, or you want to set up a limited liability partnership. Or in case if the plan is just to understand the market, then the option of a license office or a branch office or a project office can also be considered. So structuring the local presence is important. Also, sometimes because the sector is under partially under the automatic route and partially under the approval route, so sometimes foreign investors prefer to have a joint venture also. So joint venture considerations should also be taken into consideration, specifically those sectors where foreign investment is only partially allowed. Structuring of your local presence and the jurisdiction where the entity has to be set up, that becomes very important as a key consideration for investing in India. Under the foreign investment policy, flexibility has also been provided to foreign investor in case if they do not want to make entire investment in one go. Then the foreign exchange law provides for deferred consideration mechanism, which means that foreign investor can hold up to 25% for a period up to 18 months of the overall consideration, and then it can hold it back, and then that should be absolutely fine under the Indian FDI policy laws. Also, several times we have seen in transactions there is a requirement of indemnifying the buyer in case if there is a contingent event. So even indemnity provisions have been provided for under the foreign direct investment policy, and total consideration of 25% of 25% of the total consideration as well for a period of 18 months, indemnity can be provided for. And likewise, escrow mechanism has also been provided to protect the parties when they are actually making investments in India. Then, of course, there are certain mergers and acquisition considerations. For example, when you are making investment in India, in addition to looking at the options for making investment under the FDI policy, one also has to see, what are the thresholds which had been provided for in case if antitrust regulation gets applicable. Likewise, from a tax perspective, because India has signed various tax treaties with various jurisdictions, so it is important to identify which is the jurisdiction for making investment in India from a tax efficiency perspective. Likewise, exit mechanism or exit strategy is also very important, because any repatriation of money from India is freely permissible. There is no restriction under the foreign investment policy or any of the rules and regulations framed thereunder. So, from an strategy perspective, it is important to comply with those laws, even though the money is freely repatriable and there is no restriction. Beneficial ownership is also important to check whether there is a requirement to get either Press Note 3 approval, which we discussed in detail, or whether there is a requirement to obtain security clearance in certain sensitive sectors. So it is important to identify the beneficial owners and accordingly make those declarations to the sector regulators or the authorized dealer banks. Then we have also seen, there is increased regulatory scrutiny with respect to foreign investments, and that is in view of the fact that certain sectors are considered as sensitive sectors. So from that perspective, government wants a security clearance. In addition to that, enforcement directorate or the investigating arm of government of India or the Reserve Bank of India, they are also looking at previous non-compliances, if any, in relation to any of the Indian target. So there is an increased scrutiny with respect to those targets, as well as government also wants to make sure that any investment which is basically repatriable, freely repatriable, that should be in compliance with the Indian laws and regulation. And also from a compliance perspective, it becomes very important to make sure that your existing investments should be in compliance from a filing perspective with the applicable foreign exchange laws. Then downstream investment is also allowed. So if a foreign investor which already had made investments in India and it has a foreign owned and controlled Indian company in which it had previously made investments, so they can also make downstream investments by way of acquiring another Indian company. The law clearly provides that. What is to be kept into consideration or in mind is that the fund should be either be coming from outside India for making such downstream investment, or it should be from the internal accrual of the existing foreign owned and controlled Indian company. It cannot leverage or take money in form of loan from the domestic market to make such downstream investment. So it becomes very important to keep into consideration these factors when you are actually investing in India. And in the next slide, I will be basically discussing about what are the reporting requirements. So when a foreign investor makes investment in India and post completion of the transaction, certain reporting forms have to be filled in and provided to the authorized dealer banks so that ultimately it can be reported to the Reserve Bank of India. So government has actually streamlined, and from the perspective of ease of doing business in India, they have created a particular portal, and there is a single master form through which these documents and compliances can be undertaken. So for example, if there is a issuance of shares, or there is a rights issue, or if there is a bonus issue, in that case form FCGPR has to be filed within a specified period of time. Then of course, in case if there is a transfer of shares of an existing Indian company, in that case form FCTRS has to be filed. Likewise, if there is a downstream investment, as we discussed, FOCCs, foreign owned and controlled companies, are allowed to make downstream investment. So to report that transaction, you have to file form DI. In case if the shares are to be issued or allotted to the existing employees, in that case form ESOP has to be filed. Now these are some of the broad compliances in which has to be taken on a transaction, from a transaction perspective. But in addition to that, every year also from annual compliance perspective, foreign assets and liabilities return has to be filed by every Indian entity which has received foreign investment. Now, when you are actually making these filings, it is important from authorized dealer bank and RBI's perspective that you also provide, all the KYC related documents with respect to the investors. So, for example, the authorized dealer bank will ask for a declaration with respect to applicability of press note 3, or whether the sector falls under automatic route, government route. So that kind of declaration is being asked. They also ask for the transaction documents. They also ask for valuation, because under the foreign direct investment policy, clearly it is provided that if transaction is taking place, either primary, which means issuance of shares of an Indian company, or secondary, which means transfer of shares of an Indian company, in both cases pricing guidelines have to be complied with. The idea of pricing guideline is compliance is to make sure that there should not be any tax evasion, and issuance and transfer of shares of an Indian company is basically happening at a fair market valuation. At the same time, it should also be complying with benchmarking report, transfer pricing report, in case if it gets applicable, and also at arm length. Then in case if the authorized dealer bank or if the Reserve Bank of India finds that there is a delay in relation to any of these form submission, then they also charge late submission fees, so as to regularize and rectify the non-compliances. As I mentioned, repatriation of dividend and capital is freely allowed, but authorized dealer bank and Reserve Bank of India, from a compliance perspective, would like to see that all these transactions are happening in compliance with the applicable foreign exchange laws, and they would actually ask for basic documents. So for example, if any dividend or capital is being repatriated, in that case they will be asking about the supporting documents. They will also be asking about filing of relevant forms with respect to those remittances. And then of course they also look into the annual compliances from a comprehensive reporting perspective. And in case if they find any kind of contravention with respect to these filings, then in that case they ask the investor to get the same regularized, those contraventions are regularized. And in some cases they also ask for post facto approval and go for compounding process through Reserve Bank of India by way of a penalty mechanism. So that's how comprehensive reporting framework works. And in the next slide, actually, I will be talking about what are the challenges and how to resolve those challenges. So as I mentioned, most of the sectors are under the automatic route, but in certain sensitive sectors, a foreign investor has to keep in mind, what are the conditions, what are the sectoral restrictions with respect to that sector. For example, in pharmaceutical sector, again, there is a requirement to comply with sector related conditions. For example, existing Indian pharmaceutical company which is already doing research and development, or they are already basically producing essential medicines under NLE, NELM, National List of Essential Medicine. So in that case, they have to make sure that they are maintaining the same, even same quantity, and they are actually complying with the sectoral condition with respect to that pharmaceutical sector, even if a new investor comes in. So it is important to comply with sector related conditions. And in case if the sector falls under sensitive sector, then of course you have to make sure that the KYC with respect to the management, the security clearance form, if it is applicable in relation to that sector, that should be filed. The background check of the investor and the management or the director should be done properly, and then those compliances should be undertaken as per the requirement of the sector, as well as per the FDI policy. Now, of course, as I mentioned, foreign investment is only allowed either in equity or equity linked or equity related or equity like instruments, for example, CCPS or CCDs, compulsory convertible preference shares, and compulsory convertible debentures. And there is a restriction on hybrid instruments, although investments through optionality clauses are provided, so you can put in a call option or a put option, but it should be in compliance with foreign direct investment policy with respect to lock-in, and when you can basically convert that into equity. Likewise, in relation to CCPS and CCD, the formula for conversion should be decided upfront, and the conversion should be as per foreign exchange laws, specifically complying with the pricing guidelines. Now, we have also seen compliance related challenges. So, for example, if foreign investor wants to invest in an existing Indian company, there could be non-compliances, or there could be delay in relation to FDI compliance related forms filing. So those should be actually taken into consideration, and it is important that before making such investment, those non-compliances should be regularized, and any downstream investment, as I mentioned, should be in compliance with FDI policy requirements, specifically with respect to not leveraging any fund from the domestic market, bringing the capital for making investment either through the internal accrual or from outside India from the existing foreign investor, and they should also comply with sectoral conditions, etc., with respect to such downstream investment. Then, of course, many times foreign investor invest through a local joint venture partner. So how the governance of that joint venture entity will take place in accordance with FDI policy, how the control will be defined under the transaction documents and the definitive agreements, that is also important, specifically from a control perspective, because under the FDI policy, for FDI is also linked with control. So if foreign investor though is in a minority shareholding position, but at the same time they are exercising control through veto rights or reserve matters, then in that case it has to be in compliance with the applicable FDI policy norms. Then of course profit sharing, ratio, etc., in relation to joint venture, all of that should be in accordance with FDI policy and as per the Indian Companies Act. So that's something from a joint venture perspective a foreign investor has to take into consideration. Also, many times because of the sensitivity of the sector or because of other regulatory hurdles, we see the approval mechanism actually delays the entire transactions, and because of which it is important to take into consideration that element as well when you are actually negotiating your investment agreement or looking to invest in a greenfield investment in India. Next slide, I will be basically talking about what are ad hoc practical considerations. As I mentioned, with respect to foreign investment, in case if there is a license agreement or if there is a service arrangement or if there is a royalty mechanism provided for, and there is a agreement with respect to that, any remittance of money under the said agreement should be in compliance with applicable foreign exchange laws, and then that should be properly reported through the authorized dealer bank, and there should be supporting documents to make sure that it is in compliance with the laws. Because what we have seen, and in many cases recently government of India had actually started investigation when they have seen that the companies have remitted money in form of license fees or royalty without having a proper benchmarking report, without having auditor report, etc. So they have actually kind of made this allegation that these remittances from India is actually a form of siphoning of the money. So it is very important to structure your remittance arrangement specifically in form of license services, etc., in compliance with the foreign exchange laws of India. Also, under the Indian foreign direct investment laws, issuance of shares for other than cash consideration is also allowed. While, as I mentioned, that investment can be made in form of equity or equity-like instruments, but in case if the foreign investor has existing, dues which it has to recover from an Indian party or an Indian company, or in case if they have actually provided any kind of machinery, or if they have actually giving any license, technology license, etc., against that also shares can be issued in compliance with foreign exchange laws of India. So it says that if these issuance is happening in a sector which falls under the automatic route, then it has to be in compliance with the sectoral conditions. And in case if it is happening in a sector which falls under the government route, then in that case it should be only after government approval these shares should be issued. But having said that, the flexibility has been provided for, and in case if there is no cash, then or the cash element is not involved in relation to that transaction, that is also allowed. Ultimate beneficial owner of the investor is very important aspect. So therefore it is very important that in all these transactions, either at the global level or at India level, one should identify who the beneficial owners are, whether there is any sensitivity allowed with respect to those ultimate beneficial owners, because the requirement of beneficial ownership is not just from a press note 3 perspective, but it is also applicable in relation to disclosure requirements under Indian Companies Act with respect to declaration of significant beneficial ownership. So that is an important criteria. Sectoral compliances are very important, specifically with respect to certain sectors which are sensitive or certain sectors which are strategic. For example, under the e-commerce sector, in relation to e-commerce sector under the FDI policy, clearly it provides that only marketplace based model FDI is allowed in relation to e-commerce. So therefore it should be clarified, and the arrangement should be made in such a manner that it should not look like that the FDI is coming in an inventory based model in relation to e-commerce. Likewise, pharmaceutical sector, again, while FDI is freely allowed in relation to a greenfield pharma, but when it comes to brownfield pharma, up to 74% is under automatic route. Beyond that, up to 100% is under government approval route, subject to sectoral compliances with respect to research and development expenses, national list of essential medicines. So these compliances should be undertaken. Likewise, there are other sectors as well. For example, real estate and development, construction category. There also there are sector related conditions. For example, what would be the lock-in, when you can make an exit. So these kind of sectoral conditions should be complied with. Now, one more important aspect with respect to any particular land being held by a foreign investor, because under the FDI policy and foreign exchange laws, a foreign investor, then they set up an Indian company, they can acquire a land or an immovable property to carry on their businesses. Now, it has not been clarified whether they can acquire an agricultural land or a commercial land or a residential land. But what had been our advice always, that when you are acquiring a particular land, make sure that the land usage should be in accordance with your commercial activity, and it should not look like that you are actually undertaking real estate business by holding the land, getting it appreciated, and then selling it off. Because there are many cases where investigation had happened only on the pretext that company has purchased an immovable property, they have not done any and business activity, and then they sold off the land after a particular period of time, after having substantial gains in relation to that land. So it is important to structure and make sure that in your financial statements, how you are categorizing and how you are actually holding that particular land, and then the uses becomes very important from a foreign exchange law compliance perspective. Lastly, director of key managerial personnel from neighboring countries. What we have been observing is that now government is also looking at the role of the directors of the investor entity which is actually making investment in India in a particular target. They are looking at the role of director from influence perspective, also from a control perspective, and whether they are exercising any kind of significant control in relation to that. So what I'm trying to highlight in this particular segment is, what are the practical consideration and how one should actually evaluate when they are actually making foreign investment. Now, in summary, as I mentioned, Indian foreign exchange law is quite comprehensive, transparent, and therefore it becomes very important to comply with its applicability. Very important to do your due diligence with respect to existing FEMA compliances, which are applicable in relation to your investments, approval requirement or automatic route in case if it is falling. Do your due diligence with respect to existing non-compliances, any historical non-compliance that should be rectified, regularized, and all the filings should be made properly. Also look into the sensitivity of the sector, whether any kind of security clearance is required, for example in defense, in telecom, in broadcasting. These are sensitive sectors. Space sector, again, while FDI is allowed up to 100%, but because sector is considered sensitive, so security clearance element gets involved, and therefore it becomes important to comply from a security clearance perspective. Resolve all your prior non-compliances, which becomes very important. Make sure that the investment is actually being made through an instrument which is actually freely allowed, and it should not look like the investment is in form of an assured return or in the form of debt. Compliance with your downstream investment is most important, so therefore take into consideration that as well. And in the next slide, actually, I will be just concluding broadly, because from an Indian market perspective, Indian economy perspective, we have a very liberal, open economy. There's a huge potential, and in most of the sectors, government is actually trying to attract foreign investment through various incentives and schemes. For example, the production-linked incentive scheme, which my colleague Prasenjit mentioned. This is a sector where government is actually promoting manufacturing, and also they have launched Make in India scheme. So these are sectors where government is actively promoting foreign investors to make investment. Also, government have taken multiple steps to liberalize and help our ease of doing business ranking moved from 150 to now top 50. So there are a lot of relaxations which had happened. Policy had been liberalized and streamlined. Then of course they have recently allowed swap of equity instruments in relation to an investment abroad as well, which was not clear previously. With respect to regulatory landscape, they have clearly laid down standard operating procedure, and from a sector specific perspective, they have clearly created a single window mechanism through which one can actually try and obtain those licenses and clearly interact with regulator. So in a nutshell, yes, there are opportunities, but it is also important to navigate the market in a careful manner and make sure that you are on the right side of law when it comes to foreign investment. So I hope this was useful, and then I'm more than happy to address any queries which you all have. And then now I give it hand over to my colleague Prasanjit. Thanks a lot for listening to.
Thank you, Atul, for that really insightful presentation. It has certainly sparked some very interesting questions from our audience. I would like to take this opportunity to ask you to share your thoughts rather on a few of them. Uh, the first question, unsurprisingly, is actually on press note 3. Uh, and there are actually two, three questions. I will just club them for ease of your response. I think, is what are the key challenges in obtaining this approval? Why did you single it out as a separate point in your presentation? So audience is asking, what are the challenges you have encountered in obtaining these approvals? And also, can you give few examples to demonstrate the complications you encountered?
Sure, I think this is a very good question, and this is a question we actually encounter on a daily basis. So, see, from government's perspective, the idea of Press Note 3 is to kind of, do a security background check of the investor, specifically, from China and Hong Kong, because under Press Note 3, Hong Kong is also covered, within the framework of China. And government actually looks into the sensitivity of the sector, the sensitivity with respect to the background of the investor, their management, and what role they are going to play with respect to the sector in which they are looking to make investment. So what we have been observing, and in most of the cases where we have obtained approvals, government is very clear on certain aspects that the investor should not be linked with any political establishment or government agencies in any of the country which shares land border with India. That is the most important consideration. Also, the thrust of the government is to get technology. So they also like to see what kind of technology they are bringing in, whether it's a disruptive technology or whether it is will basically enhance the economy and that particular sector in an innovative manner. Also, from government's perspective, when they are looking at Press Note 3 applications, they want the control. I mean, they definitely, it's not written in black and white, but the thrust of the government is that the control should be in the hand of the Indian entity, or the Indian nationals. So they are preferring more and more of a joint venture model, where the foreign investor is actually not just making investment, but they are also bringing technology, they are also developing that sector, they are also training or kind of working in tandem with the Indian joint venture partner. And it is also kind of helping Indian economy at large, making the sector better and creating more and more employment opportunities. So if there is no sensitivity allowed, there is a joint venture partner, and it is helping the technology and the sector at large, and it's also promoting some of the key ideas of the government. For example, manufacturing in India, exporting from India in terms of all the policy guidelines which government had laid down. Then government is comfortable. But otherwise, if there is any linkage with Chinese political establishment or any of the political establishment in any country which shares land border with India, then it's a problem from government's perspective. Also, government is very clear that they do not want investment in sensitive sectors. For example, sensitive sectors means, from government's perspective, it means defense, space, telecom. That is where they are clearly not open to foreign investment from a country which shares land border with India.
Right. So that is very helpful and clear. I think one connected question, Atul, is as you, I think, mentioned also that this whole Press Note 3 was an origin because of the geopolitical issues between India and China. Now, with in recent times some positive developments between these two countries, do you think that getting approvals will become slightly more easier and the timelines for getting approvals will shorten? What is your insight on that?
Yeah, no, I think, recently in the BRICS meeting, which had happened when, the Indian Prime Minister as well as Chinese Premier, they met. And then, what we understand that certain agreements had been signed between both these governments to kind of streamline and those issues which were creating certain rifts, that had been probably resolved. It would be too early to say at this stage, but having said that, as I mentioned, government is very clear. If you are complying with the local laws, if your investment is helping the sector and you are bringing in technology, you are empowering the local partner, and of course, it's not a sensitive sector, and you are also complying with data related issues, because data is an important aspect from government's perspective. So if you are complying with data related issues, then I think government is comfortable. To answer to your question, it would be slightly early, but we feel that sectors which are not sensitive and those low hanging fruits should be easily addressed to by the government, and we hope to see more and more approvals coming specifically in relation to those areas.
Good. So early to say, but definitely a step in the right direction.
Absolutely.
Moving on to the second question, Atul, this is again, you have spoken at length about foreign exchange management Act and so many compliances. Uh, Question squarely on this that if during a due diligence exercise you identify non-compliances, now how do you go about tackling those issues? Any non-compliance on the Foreign Exchange Management Act?
So what we do, Prasenjit, is we actually first advise our clients, whether either from an investor's perspective or from target's perspective, is to make sure the house is in order. Because if you are making investment and if there are non-compliances, and if you go to the regulator for, if you are under the automatic route, you have to do the compliance related filings. At that time, the regulator will identify those previous non-compliances, and they may try to block your investment proposal, or they may try to delay it, or they may ask for heavy penalties. So what our suggestion would be, whether the sector is falling under the automatic route or whether it is falling under government route where you have to go to government for approval, we suggest that make sure your house is in order, rectify your previous non-compliances, reach out to the regulators actively, show your bona fide, and in case if the non-compliances are inadvertent or because of policy ambiguity, then in that case we kind of reach out to regulator to make sure that it is addressed properly. And thereafter, in case if any penalty or compounding is applicable, then we just advise our clients to pay that, and once the house is set in order, then you make those investments. That would be ideal. Otherwise, it will lead to investigations, and tomorrow enforcement directorate will start investigating, then it will be a bigger problem. So the idea is, and advice is to make sure house get sets in order.
Yeah, that's very interesting. And Atul, and you mentioned about penalty. So one connected question which I will club is the question being asked is what kind of penalties have you seen being imposed? Second limb of the question is have you seen a transaction being unwound because of a foreign exchange non-compliance, particularly if it's a, let's say, grave non-compliance, and who bears the penalty, the foreign party, the foreign investor, or Indian company? So clubbed with all these penalty questions, if you can shed some light.
Yeah, absolutely. So uh, from a penalty perspective, the law clearly provides that the penalty can go up to 3 times of the amount in question. So if there is a contravention, it could be up to 3 times. But having said that, the Reserve Bank of India has actually provided for a mechanism. There is a formula which had been prescribed for, and they actually kind of take their view in compliance with these rules and regulations framed by Reserve Bank of India. Having said that, there are a number of factors which are taken into consideration. One is whether it was a deliberate non-compliance or whether it was inadvertently. Also, this non-compliance is because of any ambiguity in the law. So if these factors you can build in, and if you approach to the regulator, they tend to take a liberal view. Of course, they will still be complying with the formula and mechanism which had been provided for, but within that bracket also they have the discretion to take a lenient view, either on the lower side of the threshold or on the higher side of threshold. And if they are convinced, they generally kind of because government is very investor friendly, so they do not want to punish. So that's the idea. Having said that, there are two important factors also when they actually look into these compounding applications, and the penalty is also dependent on these two important aspects. One is, if there is any money laundering element involved, or if there is any kind of tax evasion which is happening, or if it is a deliberate non-compliance to kind of subvert or doing something indirectly which one is not allowed to do directly. So if the idea of the non-contravention is to kind of do any kind of tax evasion or any kind of money laundering, then we have seen severe penalties as well, in rarest of the rare cases up to 3 times also. But if you are able to satisfy the government, then we have not seen any adverse impact having on the particular transaction itself. Now to address to your second question, have we seen any kind of unwinding? Again, unwinding of the transaction will also dependent on these three factors: money laundering, tax evasion, or any kind of national security related issues. At least in my 20 years of experience, I have not seen, such instance. Because generally, the contraventions take place only because there is a ambiguity in relation to policy interpretation, or if there is any issue with respect to, non-filing. So these are two broad issues which we have seen. And lastly, with respect to your question that what happens, who will be basically bearing this penalty? See, under Foreign Exchange Management Act, generally the onus of doing the compliance is on the Indian target company, and anyone who is actually associated with the management of the Indian company. So we have not seen investors being penalized for any non-contravention, unless investors are in connivance with or deliberately doing it, for the factors which I just mentioned: money laundering, tax evasion, and these kind of issues.
Understood. Understood. That's very clear to me. Uh, I think the next question, Atul, you mentioned about some sectors which are regulated, where investment is not allowed on the automatic route. So the question really is that, what approaches can the investor use to expedite regulatory approvals in such sectors? Because, if it takes too long, it can often be extremely challenging and arduous task. So what suggestions will you offer here to expedite the approval?
So our approach would be, first of all, have a good consultant or who has experience, because when you are actually dealing with government also needs a credible partner, because this entire FDI approval process is more from a KYC perspective. Who is the investor, what is their background? So it becomes very important to have a credible face before the regulator. That's most important. Thereafter comes, based on that experience, you try and address as many questions and queries as possible in your application itself, because the process works like, once you file the application, thereafter there will be multiple queries on various accounts, and these are repetitive queries. So many times, someone who is dealing with these regulators, they understand that what kind of queries would be coming, so they try and address all of that in the first instance itself. Then of course the approach is to provide documentation in a proper manner in the prescribed format, and all the supporting documents should be provided for. Thereafter, you kind of be in touch with the regulator on a regular basis. There's a standard operating procedure also which had been laid down by the ministry department, DPIIT. So make sure that you are complying with those norms, conditions, and document requirements under SOP, and be visible to the regulator from time to time. So these are some of the aspects which one should take into consideration for expediting the approval, and also understand the sectoral requirements, the conditions, so that it should not look like to the regulator that you are trying to evade or non-complying with any of these applicable conditions.
Sure. So I'm mindful of the time on the clock and we have to go to the conclusion. But just out of several questions left, two questions, because these are more or less yes or no responses, I will ask. Two questions which have come up. One is, if a foreign investor is basically giving technology to an Indian company, or let's say IP, can it receive royalty against it, which you said you can? Is there any cap on such royalty payment or not? Is the question. The second question which is asked is, can non-resident contribute second-hand capital goods, not new capital goods, second-hand capital goods, to an Indian party and get shares in lieu of that? A quick, brief responses to these will be helpful.
Yeah. So with respect to your first question, if there is any cap with respect to royalty payment, no. Until 2020, 2010, there was a cap. There was a restriction in relation to turnover and the profits. But after 2010, government had completely removed it. So today there is no cap. You can freely remit any money from India, either under the royalty or service arrangement or any kind of arrangement, because all of this is treated as a current account transaction, which is freely allowed. Now, with respect to your second question, with respect to second-hand machinery, see, the FDI policy is very clear. Issuance of shares can be made against either against any of the dues or capital goods or machinery, but it clearly provides that it should not be second hand machinery, it should be first hand. So if it is a second hand machinery, you cannot do it under the automatic route or government route unless RBI specifically permits for the same, but we have not seen any instance RBI permitting it.
Understood. Very clear. So I think, Atul, on behalf of everyone here, I would like to extend a heartfelt thank you to you for sharing your expertise and insights with us today. Your presentation was truly outstanding, and we greatly appreciate your time and effort, as was evident by such probing questions from audience members. Thank you as well to our audience for your engagement, attention, and thoughtful questions. We really hope that you found this webinar informative and a worthwhile investment of your invaluable time. It has been a pleasure bringing this session to you. Following the webinar, you will receive a copy of today's presentation, which Atul presented, summary notes to recap the discussion, and a link to the recording of this webinar. Additionally, you will also receive a request for your feedback. Please feel free to share your comments, criticism, and compliments. All of them are welcome. The feedback form will take less than a minute to complete, and we would greatly appreciate and value your inputs. If you're interested in in-house training or have questions related to today's topics, please don't hesitate to reach out. Our contact information is available on the slide on screen. Thank you once again for joining us today, and we look forward to seeing you at future sessions of Investing in India. Thank you very much.